Well, there have been indications recently that the hot housing market may be cooling off just a bit, and if that is indeed the case, what might the impact be on the luxury, high-end housing market? Joining us is David Michonski. He's the CEO of Coldwell Banker Hunt Kennedy. David, nice to have you back. Welcome again.
Thank you, Tom.
Are you seeing some signs that housing at the high end, let's say $1 million and up, is actually slowing a little bit in price appreciation?
Yeah, absolutely. Yeah, we've got a lot more supply coming on. Existing inventory is staying on the market a lot longer. We've got fewer buyers, fewer bidding wars, and we've got a lot of new construction coming onto the market.
So it really is a question of supply and demand, as always.
Absolutely. That's what drives the real estate
What's
market.
happened? You said supply is up. There's more inventory, and higher prices tend to flush out sellers, I suspect, or bring them out of the... What's happening on the demand side? Why are there fewer buyers looking right now?
Well, we've had 5 years of tremendous price appreciation. Remember, the average home in the United States has gone up about 1.5% per year over the last 35 years. Over the last 5 years, we've had an average of 5 to 6% a year. So we've had very significant price appreciation, and we're going through a normal cooling off period. We've got a period of rising interest rates right now. We've got a falling dollar. There's risks out in the marketplace people are perceiving. And in some cases, these markets just get tired.
And it is, of course, the season, the holiday season, when a lot of people don't want to move, don't want to put their house on the market. Let's take it from both the potential buyer's point of view and the potential seller's point of view. Let's say I have a high-end home that I've been thinking about putting on the market. What is my best strategy? What kind of weight should I be ready to expect at different price points?
Great question, by the way. And the first thing is, for your seller, is you can't look at what you could have gotten last July and think that's what you're going to get over the next few months. It's just not going to happen. Right now, we've got about a 5 to 6 month supply of homes for the overall market. But at the upper end of the market, we've got about a 24-month supply of homes. So the upper end of the market's got a lot more homes available and can take a lot longer to sell.
And when you say upper end of the market, where are you starting?
We're talking about $1.5 million and up or so. That's where, in Greenwich, Connecticut, for instance, right now, for the over $3 million market, Greenwich is a good proxy for the overall luxury market. There's a 2-year supply. And over the $5 million mark, there's a 3-year supply of homes available out there. So it's going to take a seller today possibly 10, 12 months to sell their home, which is very much normal, by the way. That's not unusual. But given what's happened over the last 5 years, it's going to be a shock to some people.
If in the summer a home in that high end might have sold for $3 million, today it might sell for?
It might sell, if you have to sell it, for 10% less. 10% less. But remember, the upper end of the market is characterized by sellers who don't have to sell and buyers who don't have to buy. So what usually happens at the upper end is you get a stall. And that's where we are right now. We're going to have a stall for the next 12 to 18 months as we've got a lot of builder inventory coming on. Builders prefer to build at the upper end of the market. That's where the margins were the biggest. We're going to have some banks coming in, putting a little pressure on their builder investors to move this inventory. So you might see some price weakness there from the buy side.
As we look on the buyer's side, what tactically is my best move?
Tactically, remember that for the next 3 to 4 months is traditionally the slowest 3 to 4 month period of the market. That spells opportunity if you're a buyer. If you want to get into the real estate market, the next 3 to 4 months are tactically the time you really should be getting in there, knowing what's going on. Come March, you're going to have a lot more competition when the spring market begins. But you should go into those markets as a buyer not expecting the kind of price appreciation that you've seen over the last 5 years. You should be a user, not an investor. You should expect no price appreciation for the next year to 18 months. But 5 to 7 years from now, when on average you're likely going to sell that home, you'll probably do very well.
I love the point you made a moment ago, is that a lot of people who are sellers who might not be able to get what they thought they could have gotten 6 months ago, they think of that as, I lost money.
Yes.
Because I didn't sell at that very top tick.
Right. What they lost was price appreciation, and they lost some expectations. And sometimes that's harder than taking the actual financial loss.
All right, David Michonski, thanks very much. He's with Coldwell Banker Hunt Kennedy. All you need to know about the high-end housing market. Thanks again.
Thank you.
And when we return, it is that time of the year when we give into cravings and our sweet tooth. Our next segment will be hard to resist, I promise. CNBC's High Net Worth will be right back.